Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 120 on June 27, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Alpha Pro Tech, United Airlines, and Slack Technologies. And we discuss three new trades on Sorrento Therapeutics, AGNC Investment Corporation, and Cloudera Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now this week, the equity markets finished a few percentage points slower, so we had a little bit of a down week. The Dow Jones Industrial Average fell 855 points, closing at 25,015 points. The S&P 500 index lost 88 points, finishing the week at 3,009 points. Now it's time for the topic of the week. And the topic this week is lottery ticket options, or also known as low delta options, but we normally don't talk about low delta. So what I mean is buying significantly out of the money options that have a low cost. So a few months ago, I read about a hedge fund manager named Bill Ackman. He turned $27 million into $2.6 billion back in March. Now, how did this happen? Did he get lucky? Well, the answer is that he bought lots and lots of really low value put options. And when the market crashed in March, those really cheap options went through the roof. When I say through the roof, I mean a $10 option becomes a $1,000 option. So this is the dream of every person I know who gets into option trading. One problem is this: you have to plan on losing a lot of those $10 premiums. And oftentimes, when covering a story like this, the media will make you believe that the hedge fund manager just woke up one day, bought these options, timed the market perfectly right, and earned billions of dollars from that one decision. Now, the truth is, typically, these guys spent months building that position. Now, if you think back, remember in December and in January and in February, we were making new highs in the market every week. And if you're a contrarian investor, you're going to be looking for a way to get to benefit from a crash. So, a lot of people see new highs and they get super excited and they try to buy stock. They try to get long the market at the top while other people start planning for the crash. The hedge fund manager was most likely wrong for several months, losing cash each and every month before suddenly becoming a genius. So, how can you get involved in this type of strategy? Well, there are a couple things you have to be aware of. So first, I would look at allocating a very small amount of capital to a strategy like this. It shouldn't be more than 5 to 10% of your portfolio, because you should almost plan on losing this money. The goal, of course, is to make sure that, let's say you have a $10,000 portfolio right now, and you decide, I think the market's going lower. I'm going to buy 1,000 $10 put options on the S&P, or I'm going to buy 100 $100 put options on the S&P. The truth of the matter is you're most likely going to lose all of that money. So don't bet. That would truly be a bet. Don't trade your entire portfolio. So you need to make sure that you have the right percentage of capital allocation, because as you guys know, the goal in trading is to live to trade another day. If you go all in, you very well may be gambling and you might be out tomorrow. So you want survival. Second thing that you have to consider is time. So you want to give yourself enough time for your scenario to play out. So we're in the month of July now, and we're in the month of June, but we're trading July expiration options. if you bought a bunch of puts for the month of July, what happens if the market crashes in August? You will have lost all of your premium, right? So if I'm going to do a strategy like this, I'm looking as far out as makes sense financially. So maybe I'm looking at the December 2020 options. And if I think the market's gonna rally to new highs, I'd be looking at call options. And in this scenario, if I'm expecting the market to go lower, or I want some insurance, I want to protect my 401k and whatnot, I'm going to be looking at put options that are in December. So you look for the cheap options. So right now, the S&P 500 ETF, which has symbol SPY, also known as the spiders, is trading for around $300. Now you can buy the December 100 put for 42 cents, or that's 42 real dollars per option. Now this, of course, is purely an example. I am not suggesting it, and I also am not doing this with my own money. Now, if the market falls, these puts will increase in value significantly. And you don't even have to wait for the market to lose. That would be a 2,000 point loss in the S&P to make this money, or to make that option in the money. The value of the option itself will probably triple, if not quadruple, in value if the market drops. Even if it drops back to just 2,400 points, closer to the low that we saw this past March. So tripling your money is never a bad thing. And if you pay more for the options up front, meaning you get a higher strike option. So if 300 is the at the money right now, if you look at, say, the 200, those $200 strike puts should do more than triple or quadruple. So now the warning, of course, is that you very well may lose all of your money on this strategy. So it's important to allocate a small portion of your portfolio, and that way you're prepared for what's called this is a long tail event, right? Many of you have read the book Black Swan. This would be a Black Swan event. What we saw in March was a Black Swan event. And when those events happen, it's not if, it's when they happen, there will always be fortunes made by someone out there who, it may look like they got lucky, but they didn't get lucky. Bill Ackman has been a hedge fund manager for a long time. The guy is 54 years old and has probably been trading for 20 to 30 years, right? The media will make you think like these are, overnight successes. I remember back in 2008, I think it was John Paulson, I think was his name, who made billions of dollars trading mortgage-backed securities. This guy had been in this trade for 4 or 5 years. If you remember, the real estate market was booming in 2005, 2006, 2007. This guy had a losing position on. All of a sudden, 2008 hits, and he makes, several $billion for his firm and himself personally. It's always important to know that most overnight successes that you read about are 10 to 20 years in the making, and that definitely can be true for this strategy, but you can do it when the market's lower, you can do it when the market's higher, just based on buying out of the money, put and call options. So definitely a strategy to add to your tool belt, to take a look at. If that's something that you're interested in. Just do your research and start to test, paper trade, and see what's out there. Or just allocate a small amount of capital and dive in. So let's get into the trade review for last week's trades. We had a covered call, looked at Alpha Pro Tech Limited, symbol A as in Alpha, P as in Papa, T as in Tango. Stock was trading for $16.79, and we looked at buying that stock and selling the July 17 half call at $2.70. Hoping for a return of 20.31% in 4 weeks. And what really drew me in was the fact that a $2.70 call option on a basically $17 stock is crazy. That is huge for the at the money, so it was worth selling. APT stock grew 76 cents this week, ending at $17.55 per share. The July 17 half call that we sold gained 60 cents. So if you were to close the trade right now, you lock in 16 cents of profit. Of course, we know better than that. This trade is working exactly as planned. So as long as stock ends in 3 weeks above $17.50, you'll be left with a 20% return for 1 month of risk. So this trade worked. No adjustments would be needed. Just stay vigilant and watch that stock go higher. Now, our next two trades did not go quite as well. We'll start off with the credit spread on United Airlines, symbol U as in uniform, A as in alpha, L as in Lima. Stock ended the week at $36.84 per share. Actually, when we looked at the trade, the stock was trading for $36.84, and we looked at selling the July 36.35 put spread at 35 cents, which gives us a maximum possible loss, of course, of 65 cents over 4 weeks. United Airlines stock fell significantly this week. It dropped $3.95 per share, closing at $32.89 on Friday. The out-of-the-money put spread we sold is now in the money by a few dollars, and the spread is currently priced at its full value of $1, which means that we currently have lost our maximum amount, which is 65 cents per spread. Because of that, there's no reason to exit this trade. The maximum loss has been reached, and you've got 3 weeks left, so it literally can only get better from here. With 3 weeks left, there's always a chance that the stock price heads higher from here. And if it heads lower, there's nothing to worry about because the spread is already pricing at its full value, which is $1. And in general, when you've reached bottom, there's only one place to go. So I wouldn't touch this trade at all. I would just hold on to it. You've reached the lowest point. We size trades appropriately, so we know right off the bat we might lose our maximum possible loss. We've done it, but now there are 3 weeks for United Airlines stock to go higher and to give us some more money off of this trade. This trade could still end up finishing out of the money, which would mean that we get to keep all of the money. Now, normally, in a scenario like this, I would look at selling a call spread to offset some of the loss. However, the call spread would need to have a higher strike value than the put strikes that we sold in order to avoid, you just never want the possibility of the call spread you sold and the put spread you sold both finishing in the money, which would mean locking in a loss on both sides. That wouldn't reduce risk, that would actually double your risk. So the call spreads right now don't have the higher strike call spreads, that is, they don't have enough premium to justify altering the risk of this trade. So I would just wait. I'd wait to see what happens in the stock over the next few weeks. There's 3 weeks left until expiration. Again, if it goes lower, who cares? Because this trade, we can't lose any more money on this trade. However, if stock does go higher, there's a good chance that we make back some of the loss and end up in a scenario where this trade could actually end up finishing out of the money, which would allow us to keep the money that we sold it for, that initial 35 cents. So that's it for the credit spread for the week. The debit spread as well worked me over, pun intended. We looked at Slack Technologies. The symbol is work. W as in whiskey, O as in Oscar, R as in Romeo, K as in kilo. At the time, the stock was trading for $33.13 per share. I looked at buying that July 32-33 call spread for 65 cents, hoping for a maximum gain of 35 cents or nearly 54% return in 4 weeks. Well, Slack stock fell 60 cents this week, finishing at $32.53 per share. The in-the-money call spread is now roughly at the money, and it has an intrinsic value of 53 cents, which would mark a 12-cent loss. Now, if you were to close the trade right now, you might lose a little bit more than that 12 cents due to the bid-ask spread being a bit wider. But we know that July 32 call, which we bought, is 53 cents in the money with stock at $32.53 per share. So now I would typically look at selling a higher strike call spread to offset this small of a loss, but the posted premiums, again, just don't justify the risk. You definitely wouldn't look at selling a put spread against this, because selling a put spread and buying a call spread, that's on the same side of the market, meaning they both benefit from stock price increases. So you'd simply be adding to the risk of the position, not mitigating it. And for this trade, I would look at staying in the call spread if you expect the stock to go higher from here. We are also less than our break-even point. So for those of you who really want to stick to the break-even point, the break-even was $32.65 in this spread. So if you want to adhere closely to that, you would look at closing this trade and looking at getting into a new trade, which might be selling a call spread, but you wouldn't do that with this long call spread still on. All right, now let's get into the new trades for this week. I always love talking about the new trades too. We're going to start off, of course, with the covered call, looking at Sorrento Therapeutics, symbol S as in Sierra, R as in Romeo, N as in November, E as in Echo. The stock ended the week at $5.87 per share. I'm looking at buying this low-valued stock and selling the July 6 call at 95 cents. Hoping for a maximum return of 18.4% in 3 weeks. Now you enter this trade by buying SRNE stock for $5.87 per share and selling the July 6 call at 95 cents. This trade makes the most money if stock prices finish above $6 per share. The break-even price on this trade is $4.92 per share, and in real terms, the stock purchase would require $587, and you would collect $95 for selling the option. Our next trade on the week is going to be a credit spread, looking at AGNC Investment Corporation, symbol A as in Alpha, G as in Golf, N as in November, C as in Charlie. Stock ended the week at $12.76 per share. I'm looking at selling the July 13.5 call spread at 16 cents, which could give us a maximum possible loss of 34 cents. Now you enter this trade by selling the July 13 call at 38 cents and concurrently buying the July 13 half call for 22 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices remain below $13 per share. The break-even price on this is $13.16. So in real terms, you would receive $16 for every spread that you sell, and that would leave you with $34 of possible risk per spread. Our final trade on the week is a debit spread on Cloudera Inc, symbol C as in Charlie, L as in Lima, D as in Delta, R as in Romeo, CLDR. Stock ended the week at $13.69, and this time I'm looking at buying the July 13 half call spread for 30 cents. Which could give us a maximum return of 20 cents or a 66.7% return in 3 weeks. Now you enter this trade by buying the July 13 call for $1.70 and concurrently selling the July 13 half call at $1.40. This is a debit spread because you are buying the spread, and this trade makes the most money if stock prices remain above $13.50 per share. The break-even price on this trade is $13.30 per share. And in real terms, you will pay $30 to enter the spread, and you're hoping for a maximum gain of $20 per spread. That's it for this week's show. Thank you guys so much for listening. I can tell you've been sharing this with friends and family as well because my numbers are increasing. Thank you guys so much, and thank you for those of you who emailed me. I'll be responding to those emails later today. And thanks again. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.